gold went down for a certain period. Yes, of course, gold doesn't go in a straight line. But generationally, legacy, insurance-wise, for dying paper money, it's a no-brainer. And it'll be the same 50 years from now, 60 years from now, 100 years from now. You cannot save and store value in US dollars or US treasuries anymore, especially when we're this in debt, especially when our currency is this debased. And again, doesn't mean the only thing you should invest in is gold, but if you're trying to save generationally, you have to have gold. And then people say, well, insurance is boring. But even as a second optionality, and I hate to say it, even pure speculation, gold has significantly outperformed the S&P, even this crazy S&P, since the turn of the century.
Despite the lack of love, gold has outperformed most major asset classes over the last 20 years. As the World Gold Council notes, historically, gold has generated long-term positive returns in both good and bad economic times. Renowned financial analyst Matthew Piepenburg states that since 2000, gold has outperformed the S&P 500. Based on his recent analysis, Piepenburg expresses that the key change is not the replacement of the dollar, but its repricing. He points out that U.S. 10-year Treasuries and sovereign bonds are being replaced by physical gold as reserve assets. China, Russia, and other nations are exiting their dollar-denominated holdings in favor of gold. This action should put pressure on the dollar and U.S. Treasuries, pushing central banks and mainstream investors towards the safety of precious metals and other tangible assets that cannot be defaulted on. There will be a rush out of dollars and into assets with no counterparty risk. It is just a matter of how soon it happens. Despite changing economic landscapes, Matthew Piepenburg illustrates gold's superiority over fiat currency as a savings tool. He observes that in 1920, a house cost $5,000 or 250 ounces of gold. Today, that same amount in dollars wouldn't buy a house, but 250 ounces of gold would suffice. Incontinent fiscal and monetary policy, including a U.S. budget deficit and government debt exceeding 100% of GDP, have eroded the dollar's long-term purchasing power. Since 1972, it has fallen by 99% against gold and lost 90% of the purchasing power of real goods and services. Concurrently, Piepenburg acknowledges that gold can fluctuate but states, generationally, as legacy insurance, it outperforms dying paper money. Now we present the clips of Matthew Piepenburg's insights from his recent interview with Palisades Gold Radio. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The ruble and the yuan or the real or the rupee or the peso or the British pound sterling is not going to replace the US dollar as world reserve currency. There is going to be no new currency. There could be central bank digital currencies and some IMF reset, but the dollar will still be the world reserve currency, in my opinion. What is definitely changed is not that the dollar will be replaced, it's being repriced. And that as a reserve asset, the US 10-year Treasury or the US sovereign bonds are openly and not gold-buggingly sensationally currently and in the last many years being replaced by physical gold. You can show the charts. Since 2014, central banks, in particular in the East, have been net selling US Treasuries, which they don't want and don't trust, and net buying over 1,000 tons a year in physical gold. That, again, isn't a gold bug argument. Watch what the central banks are doing, not what they're saying. And if central banks are buying gold and dumping US Treasuries, that's because they're using gold as a savings instrument and the dollar or other fiat money as a liquidity instrument. And that's exactly what our clients do. And to make sense of that, again, you save in gold now, not just as individual families. If I have X amount of ounces and grams of gold as my savings account as opposed to fiat money, if I need liquidity to buy a house or to pay for my daughter's wedding, I can sell some gold and convert it into dollars to get liquidity to pay for the wedding. But I save and store my money in gold because it holds its purchasing power far better than a US dollar or a US Treasury by extension. And again, doesn't look like a gold bug case. Keep it simple, stupid. Think about a simple example. I've said this to family offices, and I've said this to high net worth investors who are smart in a lot of ways, whether it's in medicine or cattle or mining, but they don't understand, money, and they think they do. So you have to keep it simple, stupid. Again, not meant to be condescending. And you can argue, well, there's gold consolidates and goes down, but it's really trending up. But pick your statistical window, Matt. You're just going to tell me what I want to hear. But no, think simple, stupid. If in 1920, and I use this example over and over, if in 1920 you wanted to buy a house in America, the average home price in America was $5,000. And in 1920, an ounce of gold was $20 an ounce. So if you wanted to buy a house, you could either take $5,000 in dollar bills or $20 bills or $100 bills, put it in a shoebox, walk over to the realtor and buy the house. Or you could have had 250 1-ounce coins, little bars of gold, and at $20 an ounce, those 250 1-ounce bars would also buy you a $5,000 house. Now, if you fast forward to 2024, over a century later, the average American house is now $500,000. Now, if you took that same shoebox of cash from 1920, nice old $20 bills from 1920 or $100 bills, that wouldn't buy you a house today. But if you had that same shoebox of 250 1-ounce coins or ounce of bars of gold, that would buy you a house. And my point is, gold significantly stores value better than fiat paper money. What would you rather save your money in since 1920? Those dollar bills or those little gold ounces? And again, that's how you have to understand it. And you say, well, Matt, gold went down for a certain period. Yes, of course, gold doesn't go in a straight line. But generationally, legacy, insurance-wise, for dying paper money, it's a no-brainer. And it'll be the same 50 years from now, 60 years from now, 100 years from now. You cannot save and store value in US dollars or US Treasuries anymore, especially when we're this in debt, especially when our currency is this debased. And again, doesn't mean the only thing you should invest in is gold, but if you're trying to save generationally, you have to have gold. And then people say, well, insurance is boring, but even as a second optionality for just pure, and I hate to say it, even pure speculation, gold has significantly outperformed the S&P, even this crazy S&P since the turn of the century. And again, people could argue, yeah, but Matt, that's just one statistical window. And they're right, because I don't really look at gold as optionality for speculation. But ironically, even with the biggest bubble I've ever seen since 2000, gold has outperformed the S&P total return. That means reinvesting dividends. So if gold is outperforming the stock market and it holds value more than any paper money, including the US dollar, why aren't family offices at least putting more than 0.5% or 1% of their allocations into gold? It boggles the mind. But again, it's because gold is deliberately misunderstood.
During the interview, Matthew Piepenburg emphasized that over the past 24 years, gold has consistently outperformed the S&P 500 and preserved its value better than the US dollar. Yet it remains overlooked. He believes a deliberate need for promotion by banks and financial institutions, prioritizing more profitable assets. According to the latest survey conducted among Bloomberg News readers, the S&P 500 is more overvalued than U.S. credit or gold. As much as 52% of respondents said they believe the S&P 500 is overpriced compared to these two assets. Analysts at Long Forecast predict that the price of gold will increase to $2,421 by the end of the year. Politically, he argues, gold is considered embarrassing for a heavily indebted country like the U.S., discouraging public discussion. Despite this, Piepenburg notes that many wealthy individuals, and even some bankers, personally invest in gold, recognizing its reliability as a store of value. Let's get back to the interview.
Take the last 24 years. Gold has outperformed the S&P. It's certainly held its value more than the US dollar, infinitely a better reserve asset than the US Treasury. And yet no one on Wall Street talks about it. No one in the family offices allocates. Remember, 1% allocation by family offices, the smartest guys in the room, 1% allocation to gold. Why? Because it's a barbarous relic when it's outperformed all other asset classes. Now, at least risk assets. So you got to ask, well, that can't just be a coincidence. 25 years of outperformance and still no one touches it. Couple of things. Austrian economists and Eastern investors that I talk to see through this, but the West doesn't. And I think, because they're not educated to think that way. But I also will argue it's a deliberately misunderstood asset. Because if you're a banker at JP Morgan or Morgan Stanley or Wells Fargo or Goldman Sachs and you work in the private wealth management office, or frankly, even if you work as the CFO or the COO of a major bank, you can't make money in gold. That's the first thing. Gold storage isn't leverageable. It isn't hypothecatable. It isn't the same kind of money maker that it is if you want to leverage bonds and stocks and, fractional reserve banking. Gold is not profitable, so it's not discussed. It really isn't. It's not big money in charging fees for the big banks. The only banks that lever gold are the LBMA and COMEX banks, just to keep the price artificially short. But as a profit center, gold is a no-go for banks. They want far bigger 10x returns on leverage at your expense, at your risk. So A, it's not even good for their business. B, politically, gold is the most embarrassing thing to a country that's in debt. And that is why The moment that we got off the gold reserve, the gold-backed currency in the early 70s and 71, that, Kissinger and Burns and Volcker later, what was their biggest concern when they came into the FOMC or when they came into the Eccles building every day? What's the gold price? What's the gold price? Because if the gold price goes too high, that means the US dollar is embarrassed. It means the US dollar isn't trusted. There's no incentive to talk about gold in the West. Politically, it's an extremely embarrassing, toxic topic for a country that's in debt. Now, I'm sorry, it's not a conspiracy theory, but Washington, D.C. and the Federal Reserve are tied at the hip to the two big failed banks. It's the mother bank, the Fed, and the little baby banks are the too big to fail banks. They live off each other. They make policies together. They even think portfolios together. And it's my strong opinion that gold is not good for business for the U.S. government. It's not good probably for the banks, so it's not discussed. They don't want massive demand for gold. Now, that may be a conspiracy theory, but it doesn't change the fact that if I'm a wealthy person, I don't care what my banker at Goldman Sachs tells me. I want to figure out gold on my own. They have no incentive to teach you this, which explains why, despite its massive outperformance of the S&P, its massive outperformance of U.S. Treasuries, no one holds it because it's criticized as a gold bug conspiracy theory about the end of the world. I was talking to someone in Scotland a couple of weeks ago, a very wealthy guy, and we went to his private wealth manager in Dallas. He said, gold. The guy laughed at him. Gold. It's so condescending. It's so ignorant. And look, I didn't grow up in my mother's basement doing Google searches to understand gold. I was a hedge fund manager. I worked in banks. I ran a family office. I understand gold. I don't laugh at it. Doesn't mean it's the only thing you should own. Doesn't mean speculation doesn't have its place. But the fact that these RIA industrial complex banking private wealth managers laugh at gold is an insult to the person they're across the table from. That's not being a fiduciary. That's being a salesman for your industry. And again, I don't think they're evil. They just don't understand it. And they don't want to understand it. And I really do believe that. It boggles my mind why people don't own more gold. What also boggles my mind is the number of bankers who are clients who own a lot of gold privately, but not in their bank accounts or not where they work, or the number of hedge fund managers I know who own a lot of gold, but don't trade it on their accounts. So there's what they say and what they do. Obviously, I'm not going to disclose who they are. It would be shocking who they are. But the smart money, even though they peddle risk assets in credit pools, private credit pools, and private equity, when they make their money, including a lot of Bitcoin millionaires, they convert it to gold to store their value.
Studies have found that gold may be an effective way to defend your wealth against inflation, but only over extremely long periods of time, measured in decades or even centuries. A 2022 insight paper from WisdomTree, looking at the investment case for gold, described the precious metal as an excellent store of value. Given the historical performance and current economic trends, how do you view the role of gold in your investment strategy for preserving wealth? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.